Good afternoon. My name is Javier Suarez. I'm the chair of the Advisory Scientific Committee of the European Systemic Risk Board, that, as most of you know, is the macroprudential authority of the European Union. The ESRB established in 2014 a prize to recognize outstanding research in the field of macroprudential policy and systemic risk. The prize was established in the memory of Ieke van der Burg, who was a member of the first advisory scientific committee of this institution, and also previously a member of the European Parliament. This is the 6th edition of the prize that normally takes place in conjunction with the ESRB annual conference. Due to the special circumstances this year, the annual conference was cancelled, and the ceremony of awarding the prize is taking place online through WebEx and also webcasted and visible to participants that I now welcome. It's the 4th time in a row that I have the pleasure to introduce the winner or winners of the prize to the macroprudential community. As in previous editions, this year there was a hard competition between many good papers that were submitted in response to the open call. The ASC had a previous stage of assessment of the papers by members of the scientific committee. After some initial grading, a short list came about, and the committee met for a long deliberation to decide which of those shortlisted papers will be our winner this year. It's one that I'm going to reveal soon. Before doing that, let me thank all of those who have been involved in making this process possible. That includes the ESRB Secretariat, giving impulse and support to the prize, also my colleagues at the committee, many of which are joining in the WebEx call today, who were very big contributors in assessing, debating on the papers this year. A special thanks, of course, also to all the researchers, all the young researchers. This is a prize to young researchers who sent their papers in response to the call. And just a reminder that in addition to the winning paper, the authors of shortlisted papers will be invited to put their papers in the ESRB working paper series that can be found in the ESRB website. Without further ado, it's my pleasure to announce that this year's ESRB prize goes to, and you may be seeing him already on cam, Marcus Inholt. He is currently an economist at the National Bank of Denmark. The paper that won the prize, as you can now see in the slides that he's starting to share, has the title Multiple Credit Constraints and Time Varying Macroeconomic Dynamics. Congratulations, Marcus. This was a paper that attracted our attention for providing a very complete, based on an Ieke dynamic stochastic general equilibrium model with financial frictions, a very complete analysis of the implications of borrower-based, quote unquote, measures, perhaps borrower-based constraints, very popular in discussions on macro-pru, like loan-to-value and debt service to income constraints. As you will see in Marcus' presentation in a few minutes, the model is sophisticated. The model deals with several occasionally binding constraints, is solved with nonlinear methods, is estimated with Bayesian techniques, and the paper even contains an empirical section providing some micro evidence supporting some of the implications of the analysis. Marcus was, if I'm not wrong, a graduate at PhD level from the University of Copenhagen, and joined first the Central Bank of Norway until very recently, where when he moved to the Central Bank of Denmark. If I'm again not wrong, Marcus has an interest in macroeconomics with financial frictions, with implications for macroprudential policy, but also, as I could see in his webpage, on climate, economic and financial implications of climate change, which, by the way, is also a topic of great interest for the macroprudential community. Before I give the floor to Marcus and we start with his presentation, couple of housekeeping notices. First, Marcus will speak. This will be for 35 minutes. I will give him notice when we are 5 minutes to the end of his allotted time. For participants joining us through WebEx, questions are welcome. We will have a 15 minutes Q&A session after Marcus' presentation. Please send your questions all through the presentation or at the end using the to all chat function of WebEx. I think with all that, congratulations, Marcus, again for winning the prize, and the floor is yours. We are anxious to see your paper presented.
Okay, thank you, Javier. I think that was a very nice, perhaps too nice introduction of me. There are three groups of people I would like to thank initially. So first of all, there's the Advisory Scientific Committee for selecting me for this prize. I think indeed it's very much in the spirit of Mrs. van den Burg. Also the Secretariat and the technical people who provided assistance here today. Then I would also like to thank all of you for listening in. And finally, I would like to thank my former colleagues at the University of Copenhagen and at the Bank of Norway for supporting and encouraging me throughout this project. And then I should finally say that, as Javier said, I'm very much interested in climate economics and implications of financial implications of climate economics these days. So that would also be something that I would like to talk to many of you about at some point, if you have any insights there. Okay, but now I'll go ahead with the presentation. So as I'm sure many of you know, the standard way of studying credit control on households in the macroeconomic literature is through loan-to-value constraints. So we see a simple example of a loan-to-value constraint here. In reality, however, banks and regulators in the US also impose debt service to income constraints on households when they apply for mortgage loans. This is a debt service to income constraint we see here. So debt expenses cannot be larger than a constant fraction of the household's incomes. So in this paper, I ask what the macroeconomic implications are of households facing both loan-to-value and debt service to income requirements when they apply for mortgage loans. So how do these two constraints shape the macroeconomy, so to say? Specifically, I focus on the four questions that I list here in the paper. So first I ask, at which points in time did the LTV constraint and the DTI constraint respectively, at which point in time were they dominant, and at which points were they submissive historically in the US. Then secondly, I also ask how the evolution in DTI limits, how that has shaped the macroeconomy. So in particular, were rises of in DTI limits, were they instrumental in causing the credit boom that preceded the savings and loan crisis in the 80s? And were DTI increases instrumental in causing the boom prior to the Great Recession? Then thirdly, I ask, so that relates to macroprudential policy, I ask whether the credit cycle is best controlled by adjusting loan-to-value limits to stabilize credit. So I define the credit cycle as fluctuations in mortgage debt. So is mortgage debt best controlled by adjusting loan-to-value limits or by adjusting debt service to income limits? Or is the credit cycle best controlled by adjusting monetary policy rates? So that is what has been coined leaning against the wind monetary policy. And then thirdly, I also look at how the switching between loan-to-value and debt service to income constraints, how that propagates economic shocks non-linearly through the economy. So in this presentation, in the interest of time, I want to have the opportunity to show the results from this last question, but I will, as Javier also pointed to, talk about some micro data results on this that I also have in the paper. Okay, but first I'll go to the model. I answer these questions by building a macroeconomic model with a loan-to-value constraint and a debt service to income constraint. So I'll give you a mapping of the model now. I won't have time to go into all of the mathematical details of the model, but I'll give you an overview here and on the following slides. So it's a New Keynesian dynamic stochastic general equilibrium model with two representative households. So there's a patient household who lends, and there's an impatient household who borrows. Then the debt contracts in this model are long-term fixed-rate mortgage contracts. Then we have a loan-to-value constraint and a debt service to income constraint on these debt contracts. So they apply to the impatient household who are borrowing. Then we have a Douglas goods production technology, and we have a constant returns to scale housing investment technology. And then we have nominal prices in the model, and we have nominal price rigidities. And so they are formulated like following Calvo, so staggered price setting. And then finally, we have a monetary policy Taylor rule. The members of the two households, they maximize utility. So here we see the two utility functions. And as I'm sure many of you know, it's this time preference heterogeneity which causes the impatient household to be borrowing and the patient household to be saving. And this time preference heterogeneity makes the impatient household credit constraint at the steady state and close to the steady state, but not necessarily further away from the steady state. Utility maximization is subject to two budget constraints. And as I said, the mortgage contracts are long-term fixed rate. So L and L prime denote the aggregate amount, the aggregate net amount of outstanding mortgage loans. Okay, so here we have the two credit constraints. So I'll just pause for a moment and walk you through these constraints because they are pretty fundamental to the results of the model. So we see that B prime here, and that's the newly originated amount of mortgage loans. So in every period, a constant fraction row of the members of the impatient household, they are refinancing in every period. whenever the economy is in a loan-to-value regime, in an LTV regime, then we have that the loan-to-value requirement is the dominant requirement. So that means that a majority of these row refinancing members, a majority of a LTV, are restricted by the loan-to-value requirement. So that's the loan-to-value limit times the expected value of the household's house. And the complementary minority is restricted by 1 minus, so that's this minority, that's 1 minus kappa LTV, is restricted by the debt service requirement here. Conversely, if the economy is in a DTI regime, then we still have that it's row members who are refinancing, but now it's a minority, 1 minus kappa DTI, who are restricted by the loan-to-value requirement, and it's a majority kappa DTI who are restricted by the DTI requirement. Then I assume that the loan-to-value limit, that's going to be constant through the estimation period, while I allow for changes in the DTI limit. So both assumptions can be defended on the ground that we observe a strong historical stability in Fannie Mae and Freddie Mac loan origination data, while so that's in the LTV limit, while this is not the case in the DTI limit. This fluctuates much more over time. And in the paper, I actually evaluate how my DTI limit, how that resembles the upper percentiles in the Fannie Mae and Freddie Mac data. And so I have a figure showing that there's a very good correspondence. Then we have the intermediate firm that produces consumption goods and investment goods and intermediate housing inputs. So that's from the goods production function. And then we also have the housing transformation function. Then we have a price Phillips curve giving us inflation. And we have a monetary policy Taylor rule here. And we have 4 market clearing conditions. Okay, so after having compiled all of these equations together, I solve the model and I estimate the model. So I use the piecewise linear technique from Guerrero and Jacobiello. With this approach, the model will always be in one of 4 regimes. So there's a loan-to-value constraint, or the loan-to-value regime where the loan-to-value constraint binds. Then there's a debt service to income regime where the DTI constraint binds. Then there's a regime where both constraints are slack. So the household will be, the impatient household will be credit unconstrained in this period, in this regime. And then there's a knife edge regime where both constraints are binding. I calibrate a few of the parameters in the model, and then I estimate the remaining parameters and the shock processes by Bayesian maximum likelihood, as Javier already told you. The debt service to income limit, I set the front end limit to 28%. So front end, that means that it's only mortgage related debt expenses. And I also have a back end limit, so that is 43%. So that includes other kinds of recurring debts. So that could be student loans or car loans or credit card. Yeah, the debt limit consistent with them like the only mortgage debt in the model, that's 28%. Then we have a loan to value limit of 82%. I estimate the model on 6 variables. So we have personal consumption expenditures, we have mortgage loan liabilities, then we have real house prices, we have disposable personal incomes and employment, and price inflation. And we have 6 shocks in the model, including this DTI shock that I told you about before, which causes fluctuations in the DTI limit. Okay, so after having estimated with the model, we get some results out of the estimation. So I'll walk you through some of these results now. So one of the first thing we can see with this model is when the respective two constraints, when they have been dominant and when they have been submissive. So we see that across this estimation period, so this is the estimation period going from 84 to 2019, we see that it's always the case that one of the two constraints at least is binding. So borrowers have in general been credit constrained. We also see that there's a tendency that the loan-to-value constraint binds during and after recessions, while the DTI constraint binds deep into expansions. So this dichotomy was the case during the following the twin recessions of the early 80s here, with the loan-to-value Lagrange multiplier being positive. Then later on, we saw that the DTI multiplier is positive here in the 80s boom. And then around the early 90s recession, the LTV multiplier is positive again. Then later on, the DTI constraint would start binding in this period here. Also during the mild early 2000s recession. So we don't see the LTV constraint start binding here. Then around the Great Recession, we again see the loan-to-value constraint binding, and then in the following boom, we again see the DTI constraint binding. So second, I look at what causes these two constraints to bind at given points in time. So this chart here sheds some lights on this. So here I superpose the time series for house prices and for personal incomes. So the model is estimated on both of these time series. And so I superpose these time series upon shaded areas indicating when the loan-to-value constraint is binding and when the DTI constraint, the debt service to income constraint, is binding. The red area, loan-to-value constraint binds, blue area, DTI constraint binds. So here we see that house prices are more volatile than personal incomes. So this implies that in recessions, for instance, house prices fall more than personal incomes. So this tightens the loan-to-value constraint more than the DTI constraint is tightened in recessionary episodes. So both constraints are tightened in these periods, but the loan-to-value constraint is tightened more than the debt service to income constraint, hence causing the loan-to-value constraint to be the effective constraint in these periods. Conversely, in expansions, we see that both constraints are actually relaxed, but the loan-to-value constraint is relaxed more than the debt service to income constraint because house prices increase more than incomes. So this unbinds the LTV constraint, prompting the DTI constraint to bind. Then also this switching over the business cycle is accentuated by countercyclical monetary policy, which tends to tighten the debt service to income constraint more than the loan-to-value constraint in expansions. So that's because interest rates have a larger effect, a stronger effect on the DTI limit than on the LTV limit. So the DTI constraint is tightened more than the LTV limit by countercyclical monetary policy in expansions, and vice versa in recessions. So that was the first set of results from the estimation of the model. Then the second set of results, that's about the historical path of DTI limits. So looking at this chart, we see that DTI limits have undergone two boom busts in the past 36 years. And this is largely disjunct both from the switching between constraints, and it's also disjunct from the business cycle. So that makes good sense that it's disjunct from both of these phenomena, because I just told you that the switching between constraints, that relates to the business cycle. So this existence of a slowly moving DTI cycle, that's consistent with, for instance, Borio and co-authors, who find evidence of this slowly moving financial cycle in many countries. So we see that the DTI limit rose during the 80s when financial markets were liberalized, and then it peaked about the time of the savings and loan crisis, after which it fell again. And then later on, we again see DTI limits rose during the 2000s boom, and then it fell abruptly during and after the financial crisis. Okay, so that was the second set of results. Then we come to the third and the fourth set of results now. So they relate to macroprudential issues. So my motivation for looking at this is that there's a growing literature showing that credit expansions, they tend to predict subsequent banking and housing market crises. And they do so more than, for instance, asset price expansions. So credit expansions, they have a stronger, they're better at forecasting banking and housing market. So motivated by this, I examined the ability of loan-to-value or debt service-to-income limits and monetary policy, their ability to stabilize credit. So first, I augment the two credit constraints, the loan-to-value constraint and the debt service-to-income constraint. I augment those with two macroprudential stabilizers. So there's a loan-to-value stabilizer and there's a debt service-to-income stabilizer. So they change the loan-to-value limit and they change the debt service-to-income. So both stabilizers, they respond negatively with the unit elasticity to expected deviations of the aggregate amount of outstanding mortgage loans. So L prime, as you may recall, that's the amount of outstanding mortgage loans. So they respond negatively with an expected deviation to outstanding mortgage loans from its steady state value, from its long run value. So what I do in the simulations is that I calibrate the model to the posterior mode. So that's the parameter vector preferred by the estimation. And then I shock the model with the shocks that were identified in the estimation at the posterior mode. So in absence of any counterfactual policy, then the model will, by construction, match the data that it was estimated on. So this is the case in the black scenario here. So that's the one called actual. So here we see that the loan-to-value limit is constant at these 82% that it's calibrated to, and the debt service-to-income limit fluctuates commensurate with the identified values in the estimation. So we see a rise in the DTI limits here and then a fall here. So that was what I showed you in the figure before. Then with the LTV policy, then we see that the LTV limit is lower in the boom years. So that's the red line here. And it's higher in the bust years to support credit availability. So we see, but then we see, if we go up here, we see that even though the loan-to-value limit is higher here in the boom year, is lower in the boom years, then credit continues to grow. So that's because most borrowers were DTI constrained in these years. So even though the LTV limit is lower, credit still grows because house prices are booming. Conversely, in the bust years, we see that actually in this period here, the loan-to-value limit is able to, the higher loan-to-value limit is able to stabilize credit to some extent. So the deleveraging in this period is mitigated relative to the historical scenario. So the converse effects apply with the DTI limit. So here we see that this policy with the DTI policy. So this policy is able to prevent credit from growing in the boom years. So the credit expansion is roughly halved, while in the bust years, where most borrowers are LTV constrained, the credit still falls. So if you want to have a very smooth credit process, then we should merge the LTV policy and the DTI policy into a two-stringed policy entailing that both loan-to-value limits and debt service to income limits, they respond countercyclically to deviations of credit. So that's the green scenario here. So that's the simulation giving the stable most credit path. And then finally, I look at leaning against the wind monetary policy. So here I augment the monetary policy rule, which in the baseline was only this black text here. I augment this with a term responding positively again to expected deviations of home loan liabilities from its long run level. So here. And then I again simulate the model at the posterior mode. So I get these results. So we again have this black simulation here. So that would be the one called actual in the previous figure, where the model evolves as it did, as the economy did historically. Then we also have the this green simulation here. So that's with leaning against the wind monetary policy. So here we see that leaning against the wind is able to stabilize the credit path, both in expansions and in recessions. So both when the loan-to-value constraint is dominant and when the debt service to income limit is dominant. So this is to a large extent, so this ability is to a large extent, but not only, but to a large extent a result of the model having the also having the debt service to income requirement. So we see that if we compare the red simulation here, so that's a version of the model that only has a loan to value constraint. So in this case, a monetary policy is much less potent than in the situation where we have two constraints. But this is actually a positive result, just looking at this figure, that monetary policymakers can influence the credit cycle. Then finally, I compare the two-string policy, so the loan-to-value, debt service to income policy here. I compare that with the historical benchmark and with the loan-to-value limit over here. And the metric I use to compare them, that's called consumption at risk. So as I'm sure many of you know, consumption at risk, that's inspired by value at risk in the finance literature. And it's the 5 percentile deviation of consumption from its steady state level. So the intuition behind this metric is that negative deviations of consumption, they constitute a worse problem than positive deviations from a benchmark. I think that's something many people would agree to. Okay, so we see here that the too stringent policy, this is able to redistribute consumption risk from the patient household to the impatient household. So consumption at risk becomes more negative in the patient household. We see so it increases from 3.7 to 4.5, while it becomes less negative in the impatient household. So it decreases numerically from 15.7 to 11. So that's nice. So this is not the case with leaning against the wind. So leaning against the wind actually redistributes consumption at risk from the patient household to the impatient household. So that's not good for distributional motives. And this is actually quite intuitive, because what leaning against the wind implies is that the interest rates should be high whenever the impatient household is very much in debt. So in that way, the impatient household's debt expenses are on average higher with the leaning against the wind policy. So if macroprudential policymakers also care about redistribution, then they should prefer the too stringent policy, policy here over leaning against the wind. Okay, so I'll just pause now. So this was all of the results from the theoretical model. Javier, how am I doing on time?
You are doing very well. So if we look at the original schedule, you will have 5 more minutes to go.
Okay, so that's excellent. Because now I'll talk about some of this panel evidence that I have on state-dependent credit elasticity. Okay, so the DSGE model implies, so I haven't shown you this, but if you look at figure 3 of the paper, then you will see that the DSGE model implies that whenever the housing wealth to income ratio, whenever that is relatively low in this economy, then a majority of the borrowers will be constrained by the loan to value requirement. So that's because the value of their collateral is low relative to their incomes. So in these cases with a low loan to value, housing wealth to income ratio, whenever it's low, yeah, as I said, the majority of the borrowers are loan to value constraints. And in these cases, then house price growth will have a relatively strong effect on credit. Conversely, if the housing wealth to income ratio is relatively high, then it will only be a minority of the borrowers who are constrained by the LTV requirement, and a majority of the borrowers will be constrained by the debt service to income requirement. So in this case, the house price growth should have a smaller effect on credit growth. Of course, so I don't show this in figure 3, but in this first case up here, then income growth should have a relatively weak effect on credit, and in this latter case down here, then income growth should have a relatively strong effect on credit growth. So that's actually the 4 hypotheses that I now test. So this change in the effect of house price growth over the business cycle and the effect of income growth over the business cycle. Okay, so the way I do this is that I estimate the following a second stage regression model on a county level panel data set in the US going from 91 to 2017. So it covers all US counties subject to some limitation on transaction volumes not being comically small. So in all 50 states and in the District of Columbia from 91 to 17. So this is the regression model. So I regress mortgage debt originations. So that's this thing over here. I regress that on some dummy variables here, and on house price growth and on income growth. But then I interact house price growth and income growth as follows down here. So in cases where the house price to income ratio in a county is above its long run county specific trend. So when the house price to income ratio is relatively high in a county, then this LTV indicator will be 0 and the DTI indicator will be 1. So then this elasticity over here will also apply. Reversely, whenever the house price to income ratio is relatively low in a county, then this loan to value indicator here will be 1, and this DTI indicator here will be 0. So that's how these two indicators switch over the business cycle. And I estimate these long-run county-specific levels. I estimate them with quadratic or cubic log time trends. To obtain exogeneity, I do 2 things, and I do them at the same time. So first of all, I have these county fixed effects, and I have some time-varying state fixed effects. So time-varying state shocks like fiscal shocks or state regulatory shocks, they'll be captured by these effects. And then also I have this Bartik type house price and income instruments that I won't talk about now. So I estimate them in some first stage regressions where my explanatory variables here are the predicted values. Okay, so I get these results. So first I have this unconditional specification where I only have house price growth and income growth in the model. So here we only have that house price growth has a statistically significant effect on credit originations. Then, for instance, if we go to the cubic specification over here, so here I have a cubic long-run county-specific trend. In this case, it's the case that house price growth only affects credit growth whenever the incomes are already high. So that's so house price growth only has an effect whenever this income indicator and then whenever the loan to value indicator is 1. So that's when incomes are high. And conversely, we have that income growth only affects credit whenever house prices are already high. So that's this thing down here. We also have the quadratic effect where house price growth always has an effect on credit growth, but that this effect of house prices on credit is amplified by the loan to value constraint bind. And then we only have an effect on incomes when on credit whenever the DTI constraint. So whenever incomes are relatively. So these results are very much in line with the model. So, and the results are also robust to a number of specific different assumptions that I mentioned here. Okay, so to sum up. In this paper, I built and I estimate a New Keynesian dynamic stochastic general equilibrium model with a loan-to-value constraint and a debt service to income constraint. The estimation tells me that the LTV constraint tends to bind to contractions, while the DTI constraint tends to bind in expansions. So that's because house prices are more volatile than incomes, and it's also because of countercyclical monetary policy. Then we infer that from the estimation that the DTI limit was relaxed from 39% in 98 to 56% in 2008. So there was an increase. And this is consistent with Fannie Mae and Freddie Mac loan level data. And then finally, we have the macroprudential experiments telling us that the DTI tool is mostly effective in expansions, and the LTV tool is mostly effective in contractions. So we can use the DTI tool to curb credit growth in booms, and we can use the LTV tool to support availability. But of course, I don't have any, for instance, financial stability concerns. For instance, related to loosening LTV limits too much in recessions. And then finally, we see that leaning against the wind may also do this, but unfortunately, it's not good for redistributive purposes. And then finally, we have this state-dependent evidence showing that the effects that we see in the model, the impulse responses that we see in the model, they align very well with what we observe across US counties.
Thank you, Marcus. I think that was a great presentation. Actually, opposite to what I mentioned to you in the preparation of this event, maybe you can keep your slides there, because maybe some of the questions will lead you into some of the slides you presented to provide a more more precise answer. So now we have at least 10 minutes for questions from this virtual audience. I'm really sorry not to see faces of many of the participants at the other side of the screen, but this is sort of the type of constraints in which we are living these days. But questions are very welcome until they come, and I keep my eye on the chat of the WebEx. Let me ask one, so at least one now. I understood, I think now better than in previous readings of your paper, from your slide 11, how these at first sight convoluted dual constraints affecting the marginal borrowing in the form of mortgages of your I guess your impatient households get, right? So I think from your explanations, thank you very much. I understood that actually one distinctive contribution of your paper is adding this, in a sense, shadow binary state in the background that makes the economy switch from one constraint being the relevant one to the other constraint being the relevant one. So I was wondering, so that reminds me of sort of, say, Markov switching regressions, no? Like Hamilton's approach to modeling boom and bust. So in a sense, it's like embedding a highly nonlinear, but at the same time a little bit black box mechanism into your model, which along the other dimension says more along the lines of other models in the literature. So I wonder what should be our interpretation of what is this shadow variable, state variable that switches from one constraint to the other. What is the underlying source that provides those switches? So just from the reading of your results, I wonder whether it is house price dynamics. I mean, whether what could be switching is like actually a Markov switching type dynamics in house prices, so that essentially when house prices are booming, loan to value gets relaxed, whereas when the opposite happens, I mean, is the one that becomes binding. So I want to get your views on that. And also, given that you are providing a Bayesian estimation of your model, I think that this definitely involves, as you were showing in these nice figures, like in the Hamilton approach, is like you get an estimate of when the economy was going through each of the two states, which are these nice shadows in shadow areas in the figures you saw. So is your estimation also providing an estimate of the kappas in these two equations, meaning the fraction of households that get constrained in one way or another, since in each representative household in the background there is like a continuum of different heterogeneous households. So is that also an estimation outcome, or you assume the value or calibrate exogenously the value of those parameters? Thank you very much.
Okay, so I think those are two very good questions. So I think in terms of what causes the switching, I think this slide, so actually also I have a formal shock decomposition of the two of these two Lagrange multipliers. So that is how I can formally show you this mathematically, but it's also more convoluted to go through it. So I mean, it is this like the underlying, what drives this, the underlying causes, that's house price sentiments. So housing preference shocks. So they have a large effect on house prices. I also have a shock decomposition of house prices in the paper, so you can see the extent to which house housing preference shocks drive house prices. So these housing preference shocks are very volatile. So that then causes the volatility of house prices. And this volatility of house prices causes a lot of volatility in the loan to value requirement. And then this causes the switching over the business cycle, again, coupled with a smaller volatility in the drivers of incomes, which then causes less volatility in the DTI requirement. So it will always be the constraint giving the lowest borrowing amount, which will be the effective constraint. So yeah, and then that switches over the business cycle. Regarding the estimation, so I hope this addressed your question. Regarding the estimation of kappa, I have that is estimated, so I can show you that here. So this is a table showing the estimated parameters. So we have kappa LTV and kappa DTI down here. So this is the estimated structural parameters. We also have the shock processes. That was what I meant. We see here that the mode, the posterior mode on the kappa LTV, that is 74%. So in a typical loan to value regime, then we have that 74% of the households are constrained by the LTV requirement, and then 24% are constrained by the DTI requirement. And then in a typical DTI regime, then we have that 88% of the borrowers are constrained by the DTI requirement, and 12% are constrained by the LTV requirement. And as you can see from the posterior distribution, this varies a bit over time. So there'll be some model uncertainty in the Bayesian estimation.
Thank you, Marcus. I see now several questions, actually several from colleagues at the Advisory Scientific Committee and at the ESRB Secretariat. So actually I have a question from Martin Oenke, congratulating you for a great paper. He says, I find the policy experiments that you provide very interesting, as you explained. Some will reduce cyclicality. Are those paths indeed preferred based on some measure of welfare, or should this be read more as a positive analysis of what different policies will achieve?
So again, I think that's a very relevant question.
Please be brief, because we have several questions. Okay. But of course, I mean, answer this question. Thank you.
I mean, also, so of course, everybody should just log off whenever they're out of time. But I would be happy to take some questions even after 4 o'clock. Okay, so this is, we should see this as a positive analysis, and we should always be very careful not to use models for more than what they can be used for. So this is an example of the effects of these policies. This is not welfare optimal in any way. This model is not ideal for optimality analysis, and that's because like these regimes are piecewise linear, so we don't have higher order effects. So for instance, precautionary motives, that's not a part of the model solution.
So I understand that there is a challenge associated with aggregating welfare across the different households that you have, right? And then you use these consumption at risk metrics that actually suggest that leaning against the wind is not very good policy, not only on redistributional grounds, but also because it doesn't help match the other category of households relative to the historical experience. So let me go to a second question that comes from also my colleague Thorsten Beck. He says, one question on the income inequality implications. Do your results hold if loan to value or debt service to income tightening results in credit rationing of low income borrowers? I guess maybe one underlying question is whether your model is sufficiently rich to capture income heterogeneity, maybe.
So that's again a very good question. I I mean, so there will be income heterogeneity in the model because the savers are also the capitalists, so they own the productive capital. Uh, I don't, as such, have low income borrowers. I'm sorry, can I get the question again, please?
I read again is uh, income inequality implications of your model. Do your
Yeah.
results hold if loan to value or debt to income tightening results in credit rationing of low income borrowers? Actually, my own response to this would be that because your equations in on page 11 are sort of reduced form, maybe the answer is yes, but only to the extent that the reduced form, through these kappas, etc., captures it. But please comment otherwise.
I mean, so it's. I think the answer is that essentially I assume that there's complete income sharing within the inpatient household. So there won't be any rich or poor individuals in there. They'll all have the same income. Um,
Yes,
yeah.
but that sounds slightly inconsistent with calling, say, kappa DTI the fraction of members of the household that feel constrained by the debt service to income at the point of origination, right? So I think if at some point one opens the black box behind these constraints, I mean, it's a very useful assumption, the one that, say, consumption insurance is provided by this big dynasty to which the household belongs. But there are intriguing aspects that might deserve like a genuine, more heterogeneous agent model.
I mean, so I suppose one assumption one could make about this to save the model would be that all households have the same income. All members in the inpatient household, they have the same income, but that then they are subject to some idiosyncratic house price shocks. So that it's the distribution of house prices where they vary and not the distribution of incomes. But then if they sell their house, then they still have to pool some of these who have very high idiosyncratic house price shocks, then they still have to contribute to this common income sharing pool. Yeah.
Excellent. Yes, I think it's a very, very promising framework. So another colleague in this case from the ESRB Secretariat, Thomas Peltonen, says, thanks for the presentation and congratulations. Are you working on a European country application? Are you aware of similar analysis for European countries? Thank you.
No and no. There are a few things I would like to say there. So first of all, in terms of Europe, so this was actually something that I planned to say in my presentation. So again, as I'm sure many of you know, loan to income constraints are more common in Europe, while debt service income constraints are predominantly an American phenomenon. So I think it would be very relevant to build a model similar to the one I have for Europe. It's something that I would be very willing and very happy to help members doing if any of the member central banks or other macroprudential authorities would have an interest in this. I'm not aware of any model for European country doing this. But I think it would be
Thank you,
very.
Marcus. I think that having you in the European system of central banks is a great thing, because indeed applying this to Europe will be of utmost interest. So your offering is a very kind one, and I'm sure that you might have some jumping proposals for co-authorship of such type of follow-up. But in the meantime, I guess the challenge is to publish this paper. We wish you best luck in doing that. I think that some of the issues discussed today, also in the discussion part, might be key to actually what is already a great paper, modify some of the aspects in the introduction to make it super clear what the marginal contribution of the paper is relative to existing papers. I think you have a paper with huge amount of results, extremely rich and extremely interesting, but sometimes people want to remember one thing. And I think that one, at least my guess, is you are combining these two constraints, allowing those for this regime switching. So if we manage to understand and motivate well that regime switching helps understand a lot for in this case the U.S. economy, and has implications for the analysis of policy. I think your paper should be really very, very well published. So congratulations again. Thank you to everyone. Now we are 7 minutes past the scheduled time. I think it was interesting and worth doing this. My virtual applauses to you. I mean, unfortunately, you will not hear the applauses of anyone else, but it was great having you here in this webinar. And well, I hope that next year this ceremony can happen again in physical format. If not, we will do whatever is needed to continue the tradition. So thank you very much to everyone. Thank you, Marcus, and congratulations again. Bye bye.
Thank you very much.